Hello, this is Bill Scheid from Applied Finance Research with a look at using monthly asset allocation systems to build a system that fits you. Dr. Van Tharp taught that it's critical to your success to trade a system that fits you, and I personally couldn't agree more. Early in my trading career, I tried trading a system that didn't fit me, and the results were disastrous. Of course, at that time, I hadn't heard of Dr. Van Tharp, and I had no idea that there even was such a thing as trading a system that fits you. So what we're going to do here is take a look at two different monthly asset allocation systems that I've built to achieve two different trading objectives. One objective is sustainable conservative growth with lower drawdowns. And the second objective is aggressive growth where we're okay with higher maximum drawdowns. And as we go through this process, what I want to stress here is that the systems we're looking at are examples of configurations of monthly asset allocation systems that I personally trade, but these are by no means the only configurations of these systems and are certainly not the only results that are possible. I built these particular configurations of the monthly asset allocation systems to meet my personal objectives, but these systems, they're highly flexible and they can be easily customized to meet your objectives. So yes, we do cover these specific configurations of the systems in our courses, but more importantly, we teach students how they can modify and build their own configurations. So let's start by looking at the results for the system I built to meet objective 1, and let's see if this system configuration actually does meet those objectives. So this is a configuration of a portfolio moving average system that I've been trading for a while. And again, the objective is conservative, sustainable growth with drawdowns on the lower side. This is a backtest I generated using etfreplay.com. This backtest goes from December 31st of 2007 to September 8th of 2023. So we've included the financial crisis of 2008, the COVID crash of 2020, and everything in between. So the graph on the left is an equity curve where the vertical axis is percent return and the horizontal axis is time. The green line is the backtest of this configuration of the portfolio moving average system. And the blue line is a benchmark created by ETF Replay that represents the return of an all-world 60-40 stock bond portfolio. Now, why would we want to compare our results to this benchmark versus, let's say, something like the S&P? Well, if you're someone who wants conservative growth and lower drawdowns, you're probably not also aggressively trying to beat the S&P. Generally, those two objectives don't necessarily go hand in hand, at least not in the same portfolio. If you want conservative growth and lower drawdowns, you may be coming from more of a traditional asset allocation, buy and hold retail investor type of mindset. So the question then becomes, well, if we're going to build our own system, can we do better than what we could do if we just did the old 60-40 buy and hold thing? By the way, 60-40 does, of course, give you lower drawdowns than if you just bought the S&P, but it also gives you lower returns. So on the left, we have the equity curve for the PMA system in green, and we have the benchmark in blue. On the right, we see that this configuration of portfolio moving average returned 120.8% versus 116.9% for the benchmark. We also have volatility, which is a measurement of the annualized standard deviation of daily returns. And we see that the PMA system has a volatility of 8.5 while the benchmark is at 11.7. So in summary, this is telling us that this flavor of PMA has slightly better growth than 60-40 on a good bit less volatility. Looking at the top section here, we see that the compounded annual growth rate for this flavor of the PMA system is 5.2%, and the benchmark had a return of 5.1%. So 5.2%, what does that mean? Does that meet our objective of sustainable conservative growth? Well, here in the US, many financial advisors will tell you to plan on a withdrawal rate of 4% from your account when you're in retirement. I'm not a financial advisor, and that's definitely not advice. I'm just sharing with you what I read most often here in the US. So 5.2% growth means that you can cover your 4% withdrawal rate and still grow your capital. Now, of course, if you're paying a financial advisor, you're going to be paying around 1% or so. So here you get to keep that 1% on top of your other returns if you're running this system yourself. And so what that means is we're basically meeting our objective for sustainable conservative growth, but what about the maximum drawdown? In the top section, we see that the maximum drawdown for this configuration of PMA is minus 13.6% versus minus 34.7% for the 60/40 benchmark. So we're at roughly 1/3 of the 60/40 benchmark drawdown, which in my opinion is outstanding. Now, if we did want to compare this to the S&P, we're at about half the return of the S&P, 5.2% for PMA, and SPY returned about 9.5% for this period. But we're only on 1/4 of the drawdown. S&P had a drawdown of minus 52.3% for this period, and PMA only had a drawdown of minus 13.6%. So mission accomplished. We've met our objective for the configuration of this system. Now let's take a look at the results for the system I built to meet the next objective, objective 2, and let's see if that system configuration actually does meet those objectives. So here our objective is aggressive growth, and we're willing to accept higher drawdowns. So let's take a look at this backtest data. Again, these backtest data, these come from ETF Replay, and this backtest goes from December 31st of 2000 to September 8th of 2023. So once again, we're including the financial crisis of 2008, the COVID crash of 2020, and everything in between. On the left, we have our equity curve where the green line is the backtest of this configuration of portfolio moving average system. And this time for the blue line, we're using the S&P 500. The rationale being if you're going for aggressive growth and you're willing to accept higher drawdowns, then you'd probably at least like to beat the S&P 500. On the right, we see that this configuration of PMA system returned 917.6% for this period, while the benchmark, that's S&P, returned 312.4%. When we look at volatility, we see that while PMA had almost 300% more return than SPY, its volatility is only about 10% greater. So this is telling us that this flavor of PMA has much greater return than S&P, but on only slightly higher volatility. So looking at the top section here, we see that the compounded annual growth rate for this flavor of PMA is 16%, and S&P had a compounded annual growth rate of 9.5%. So we definitely met our objective for aggressive growth, but what about the maximum drawdown? In the top section, we see that the maximum drawdown for this configuration is minus 33.5 versus minus 52.3 for the S&P. So while we said we were willing to accept higher drawdowns, we actually end up with less of a drawdown than the S&P 500. And interestingly enough, also, this is a drawdown that's fractionally smaller than the 60/40 benchmark we were looking at earlier, which was at minus 34.7. So if we wanted to compare these results to the 60/40 benchmark, this configuration of PMA has fractionally smaller maximum drawdown than the 60/40 benchmark, with a total return that's roughly 800% greater. So have we met our objective for this configuration of this system? Absolutely, I would say mission accomplished and then some. So the key takeaways here are that the monthly asset allocations are extremely flexible and they're very highly customizable. It's one of the things that we cover in our workshop to teach students how they can configure, how they can modify the out-of-the-box rule sets to build a system that meets their personal objectives. If you want to learn more about these systems, visit us at appliedfinanceresearch.com or click on any of the links below this video. Thanks for watching and happy investing.